Good evening. On behalf of the America Society Council of the Americas, it is my pleasure to welcome you to this conversation with Alejandro Werner, Director of the Western Hemisphere Department of the International Monetary Fund. Alejandro will be having a conversation with Lisa Schneller, Managing Director, Sovereign Ratings, Standard & Poor's. Welcome, Lisa. And they will be talking about the IMF's new economic outlook for the region. I would also like to welcome everybody who is joining us through our live webcast, which is sponsored by Telefónica. Prior to being the director of the Western Hemisphere Department of the IMF, Alejandro served as head of corporate and investment banking at BBVA Bancomer, and before that as undersecretary of finance and public credit of Mexico. Thank you again for joining us, and I will turn this over to Lisa to start the conversation.
Thanks so much, Randy. Thanks to the council. It's a pleasure to be here. It's a pleasure to be with Alex. So I think look forward to talking with Alex tonight about the near term and potentially medium term outlook for LATAM, kind of as we're kicking off kind of 2015 here at the council. As Randy alluded to, the fund updated its World Economic Outlook this week. Unfortunately, yet again, kind of growth edged down globally in advanced economies and in emerging markets. And among the advanced economies, growth continues to be uneven, and really with the US kind of getting the only notch up in growth to 3.6% growth this year, which is stronger than our view at S&P. We're a little 3.3, but so that hopefully this 3.6 will indeed come out. But Europe and Japan, the outlook remains weak. In LATAM and emerging markets, generally had a markdown as well. The significant hit to commodity prices, helping some, hurting others. The prospects for higher rates in the U.S., potential volatility in capital markets. We have the fund actually moved growth in China just a bit under 7. That certainly has an impact for LATAM. In EMEA, clearly hit from Russia, the geopolitical events there, the oil price hit there with a set for contraction. The BRICS in general don't look that great. India kind of is one, seemingly where the growth looks set to improve, right, with some new policy impulse there. So turning to LATAM, the fund moved down growth almost a percentage point to like 1.3 this year, little changed from last year. Alex, could you talk to us kind of where kind of big picture, kind of the downward revision in growth for LATAM, the key challenges for the region this year? It would be great to kind of start off. We'll do some big picture and then we'll move into some country discussions.
Okay, I think, I mean, the important decline in growth that we have seen in Latin America, I mean, basically what we're expecting for 2015 is for this mediocre rate of growth of 1.3% to stay here. I mean, we had 1.3% in 2014. We're expecting the same thing for 2015. And I think what we are seeing is basically that the Southern Cone is basically working through the end of the commodity cycle. And when we say the end of the commodity cycle, basically we're saying, I mean, commodities remain at a historically high level, but they have come down from the extremely high levels that we saw in 2011 for metals and agriculture, and let's say, and now starting, let's say, in the summer of 2014 for energy, especially oil. So in a sense, I mean, a region that basically is extremely specialized in commodities, as South America went through 10 years of exceptional external circumstances coming from the high commodity prices, and then starting in 2009, 2010, also taking advantage of exceptionally loose financial conditions. So that is unraveling, and basically in different shapes. I mean, those countries that have been much, or that were much more aggressive in expanding expenditures, especially from the public sector side, suffering much more. I mean, when you see Venezuela, Argentina, etc., basically having a very hinder access to international capital markets, and then trying to work through the decline in commodity income without the possibility of smoothing these shocks that a much better access to international capital markets might allow them to do it. In economies such as Chile and Peru, we're seeing economies with a macroeconomic framework in which debt to GDP ratios are extremely low. Inflation is pretty well anchored around their inflation target, and they have a flexible exchange rate that allows some counter-cyclical effects coming from non-traditional exports. And due to the fact that fiscal policy has been relatively well managed, they have some space to conduct counter-cyclical fiscal policy, but still, I mean, working through this downward cycle. And we're seeing, obviously, I mean, Colombia having been spur of this phenomenon up to the end of 2014, and now with the price of oil declining, also entering, I mean, into this group of Pacific Alliance countries, trying to manage a negative terms of trade shock within a pretty healthy financial and fiscal situation, but obviously being economies that are extremely exposed to commodities. And then we have, let's say, the Ecuadors, Bolivias, that although more with a much heavier presence of the public sector, with a heavier expansion of the public sector, but economies that have actually maintained healthy debt to GDP ratios. I mean, they have managed public finances in a more conservative way. They have some wiggle room to adjust to these shocks. But basically, the Southern Cone working through these very important negative shocks, and then Central America, the Caribbean, and Mexico not yet feeling the benefits of a U.S. economy that is recovering faster than what we expected. So that makes for a pretty bad year in Latin America. Maybe I skip Brazil, that it's a country that has been working these excesses in a much slower fashion, let's say, than Peru or Chile, basically because the counter-cyclical policy push that was implemented in 2009 and 2010 was much higher, and I think generated much larger disequilibria than in other countries. What we are seeing in Brazil is the need for significant relative price realignment on the energy sector, on the real exchange rate, on unit labor costs that are extremely high, and obviously a reshuffling from the growth that was led in the last few years by an expansion in consumption and the non-tradable sector to a growth that should be much more sustained by an expansion of investment, exports, etc. And for that, they need basically to contain the growth of aggregate demand through the containment of the expansion of the fiscal accounts and the public banks, and the new government is doing that. They should let the currency, I mean, find its new equilibrium level without such a heavy dose of intervention, and the central bank has announced that it will reduce the amount of intervention in the second quarter, and they really need to contain uncertainty that is coming from a debt to GDP, a public debt to GDP trend that is actually generating important credibility effects on the sustainability of public finances, and the same on the inflation front, as inflation has hovered around the ceiling of the band. But when you look at the composition of inflation, when you look at non-administered price inflation, it's much higher than that. So basically, again, there they need a realignment in which administered prices cannot be the anchor of inflation, and non-administered prices have actually to go back within the band, and that's why the central bank is tightening policy. And as I said, I mean, when we look at Mexico, Central America, and the Caribbean, I mean, the important lags that it took for the U.S. recovery to actually gain traction has been affecting those economies. Secondly, I think in the case of Mexico, I mean, the significant negative shocks that the construction sector suffered in 2012 and 2013, both coming from infrastructure, but more than that from household, I mean, single-family homes, buildings. It's being corrected, and the economy is kind of in, I mean, we're expecting in a cyclical recovery, basically benefiting from the US recovery, from a weak exchange rate, from relatively low energy prices, and we are expecting the Mexican economy to start showing that in 2015, and eventually the effects of the structural reform to start feeding in gradually in the next 3 to 5 years. And in Central America, we're expecting a small, we did have a small positive revision, basically associated with what we are seeing in terms of remittances, what we're seeing in terms of tourism, and obviously the decline in the price of oil, being countries that are oil importers and where the oil import bill represents an important share of their economy, that will be a positive factor for them.
Going back to sticking with the commodity price theme, it kind of this notion of clearly there's the supply dynamic that's kind of contributed to this 50% plus drop in oil prices. But on the demand side, do you kind of, does the fund see it really pretty much of a supply story, or is there also a component on the how much of a component on the demand side, and kind of then thinking longer term in terms of what it means for potential growth in some of these
I do think
commodity exporters?
I mean, we are coming to a view that it's a balanced story, that there are demand factors, especially in the last couple of quarters that we have not the last couple of quarters. Let's say in the first 2 quarters of the decline in the price of oil, we saw significant demand factors. I mean, obviously after the OPEC meeting, in which the reaction of OPEC was not to adjust supply, whatever econometric exercise that you do start showing important supply effects as well. So we do think you have both supply and demand factors. And obviously the supply factors are those that are generating a significant positive effect for the world economy. And the bad news is those positive effects are being more than offset by other negative effects that are coming from the revision in potential GDP growth coming from EMs, and the negative news that you mentioned coming from Europe and coming from Japan and slightly from China. And I think, especially with a view from Latin America, I think this revision of potential growth for emerging markets, and I will limit my remarks to Latin America, I do think that basically reflect an overestimation of potential that we all did in the good years. Mm-hmm. In a sense, we saw these economies growing at a very fast pace for a significant period of time. All the statistical techniques that we have available at the end of the day end up having some biases towards the last few years, and to the extent that these few years keep being more and more, and you have 5 years of good growth, 7 years of good growth, it is very hard, even if you average across several techniques. I do think that, almost all the analysts ended up having an upward bias in their medium-term forecast, and now we're seeing that revision. We're seeing that, several Latin American economies didn't exhibit significant increases in investment. Being a region that historically has had low investment, and I think, the biggest example of that is Brazil, an economy that invests 17% of GDP today. Maybe at the peak of the boom, it was investing 19%. Yeah. But when you compare it with the average or the median for Asia, emerging Asia, that is 26, 27, and countries, above 30%, it's very hard to think how Latin America can grow above 2 and 3% if you're investing only 17% of your gross domestic product. And in those countries in which we saw significant increases in investment, in many of those, a lot of that investment was concentrated on the commodity sector and also on the construction sector. Basically, the huge income effect coming from the increase in the price of commodities, then feeding into financing non-tradable sectors, I mean, mainly construction. And I think all the studies that actually look deep into total factor productivity growth in Latin America show that although there has been some increases in total factor productivity growth, it's still relatively low. So it's very hard to come up with very optimistic numbers vis-a-vis medium-term growth for Latin America as a whole. And when you think that when we average Latin America, we end up having Brazil and Mexico being more than 50%, and those countries not investing too much, having very mediocre total factor productivity growth, it is hard for the Chiles or the Panamas to actually make a dent in those averages. But I do think that, I mean, for Latin America, I mean, 2014 and 2015, hopefully it's a cyclical low in terms of growth, but I mean, under the structures of the economy that we're seeing today, it's very hard to expect growth going back to above 3% in the medium run, no?
Absent some reforms. Mm-hmm. Yeah. Another kind of, I think, question that kind of market concerns is on when the Fed starts raising rates. Presumably, mid-year, but S&P, we think it's in June. How do you see kind of, the region prepare to manage this potential increased volatility, despite the QE that we're seeing? And can it be offset by the QE in Japan and by the ECB in some sense?
I mean, I do think that from a perspective of global liquidity conditions, I mean, obviously it will help. And we saw it when QE actually was announced and implemented in Japan. We saw significant inflows into Latin America. At that time, it was actually, I mean, both monetary policy stance going in the same direction. I mean, the implementation of QE in the US, together with the announcement of the Japanese QE, actually gave way maybe to the last strong leg of capital inflows into Latin America before the taper talk by the former, Chairman Bernanke, that actually generated significant volatility in local markets. I do think that countries in general are well prepared. I mean, countries have a significant level of international reserves. Some countries, such as Mexico and Colombia, has the flexible credit line with the IMF. I mean, average duration and maturity of local debt has increased. I mean, inflation is relatively low. The flexible exchange rate regime is functioning, etc. The corporates have strengthened their balance sheets in terms of also taking advantage of the period of high liquidity to increase duration and maturities. I mean, some of them may be going to the foreign currency market and maybe generating some foreign exchange mismatches, but I mean, we don't see bunching of amortizations in the next couple of years, etc. I mean, having said that, I mean, and that's what we would have said 2 years ago, I mean, obviously, I mean, all of these strengths are there, but obviously in an environment of low growth, then, I mean, what used to be a very solid balance sheet for several corporates in Latin America, obviously it's a weaker balance sheet now when, I mean, quarterly earnings will be coming down, return on equity will be coming down, EBITDA will be coming down, so a lot of these ratios will be seen a little bit weaker, and there might be scope for some surprises there. It might be some scope for a lot of volatility in the FX market. I would say that the other positive vis-a-vis what we saw in 2013 with the taper tantrum is that, I mean, with the huge movements in currencies that we have already seen in Latin America, all the carry traders are gone. So in a sense, when I mean, a significant amount of short-term investment, taking advantage of the interest rate differential in a period of ever appreciated exchange rate, that is not a problem that central banks will have to deal with under this scenario. But I do think still you might have some rethinking of the structure of portfolios, some capital outflows generating additional volatility in local markets. But I do think still when you look at the financial sector, hard to spot vulnerabilities in which the volatility in asset prices can feed into weak balance sheet and generate bankruptcies. I mean, in a sense, there might be a lot of excitement and there might be a lot of losses being taken. But going from that to the contamination of the balance sheet of banks or large corporates, as we saw, let's say, in the previous crisis in Latin America, or even, let's not call it crisis, but in 2008, there were several important issues related to main corporates in Latin America where their balance sheets were really subject to significant exchange rate exposure, and that generated a lot of problems. In the stress tests that are being done today, it's hard to spot those contaminations going from asset prices to balance sheets. We already had significant movements in the exchange rate, and nothing has appeared yet. But I mean, at the end of the day, in previous crises, we also were saying the same things. And eventually those things that we didn't see were the things that actually got them. So I think we need to continue, a very important dialogue with regulators to be extremely vigilant for this vulnerability not to start popping up in the region. No?
You mentioned low inflation in general in LATAM, and clearly in advanced economies more of a concern with deflation, but you don't have it quite that way in LATAM. Clearly, in some countries, you've got extremely high levels of inflation and the question of stagflation as well. How do you see monetary policy poised kind of across the region this year?
No, it's right that, I think given what has happened in the last 10 years in Latin America, we kind of put aside some countries and then we talk about other countries, no? And then we say we have a low inflation, etc., but we still have the country with the highest inflation in the world with Venezuela. Argentina still has, if you look at the official statistics, 25% inflation, 24% inflation, still one of the highest in the world. Then you have countries such as Uruguay with inflation hovering around 8%, etc. That, it's high for international standards. And Brazil, as I said before, 6.5%, and the non-control price inflation being very high. So I think inflation is still an issue, and I think there's a part of the region in which there's still an important challenge in setting up credible central banks. And I think that's a challenge for the region. You have a central bank that has achieved significant credibility over the years in Chile, and actually, when you see how Chile reacted to the taper tantrum, it's very interesting because the exchange rate moved a lot. Short-term rates obviously didn't move. Actually, the central bank might have a reduced interest rate, but the long end of the curve actually declined or nothing happened to it. While in Mexico, in Peru, etc., you saw, the liquidity premium going up. In Chile, obviously the low presence of foreign investors in Chile also plays a role, but it's also true that it's more of a textbook case in which the exchange rate did all the adjustment, and the domestic yield curve ended up being determined by domestic factors. Then you have the cases of Mexico, Peru, and Colombia, in which you have, very highly credible central banks, but with a strong presence of foreign investors, and therefore monetary policy has been complicated in this environment in which capital flows have been playing a very strong role, and sometimes a little bit similar to what happened with the savings glut story in the US. monetary policy authorities try to play with the short end of the curve, but the long end just goes on the opposite direction, no? And therefore curtailing the transmission of monetary policy to the rest of the economy, no? So I think, I mean, there are several challenges in terms of monetary policy. I think that's one. And the other one is this new issue of how to implement macroprudential policies. Basically, I mean, this mandate that has been given to central banks, to financial sector committees, as the FSOC in the US, etc. I think it's generating a new challenge for central bank, not by using monetary policy to achieve a new objective that will be financial stability, but yes, monitoring much more closely the possibility of mispricing, excessive leverage, etc., developing and actually implementing the needed measures to contain those vulnerabilities. I think that it's very hard to spot big problems on that front in Latin America today, but I think it's an issue that central banks will be thinking hard in the future, and more than that, the capital inflows issue. I think we saw, I mean, obviously the Central Bank of Brazil play with the capital controls a lot. On the inflows part of the cycle, we're seeing the Central Bank of Peru playing with interest rates and reserve requirements a lot, trying to handle a situation in which the banking system is heavily dollarized. So in a sense, monetary conditions do not respond only to the interest rate in soles. So if they want to tighten, they want to tighten the dollar part of their banking system, they have to use reserve requirements there. So, and then I think there's the big question that central banks are also, or might be asking themselves with respect to intervention in the FX market. I mean, we have seen the Central Bank of Brazil implement a very heavy intervention policy in the last 18 months. We have seen Peru done significant interventions in the spot market and also through swaps. And we have seen the Central Bank of Mexico, let's say, I mean, moving into the spectrum of the more conservative ones, Peru and Mexico, I mean, reintroduce their automatic intervention mechanisms when the currency was touching 15, etc. No? So I think those are the questions that authorities are trying to get answers for.
Put a couple of questions on countries on the table before we open it up to questions. You know, your comment on the two largest economies, Brazil and Mexico, not showing the kind of the stellar growth performance in recent years, and you know, in Mexico here, there's all, you know, kind of this balance, I would say, today between you know, kind of how the lower oil price outlook may impact the significant, you know, prospects that, you know, really the kind of the boon that you could get from the energy reform. How's the fund seeing kind of this in the near term or medium term, and the domestic investment climate kind of, you know, very much kind of, you know, weighed down somewhat last year also because of sentiment over kind of the fiscal reform, and I guess today questions on, you know, of you know, kind of overall investment climate in Mexico.
I do think that from a short run perspective, I mean, the cyclical determinants of growth in Mexico are strengthening, and therefore investment climate, business confidence, etc., should be picking up eventually. I mean, with the US doing better, with the decline in the price of oil, also helping what is already a very positive behavior of vehicle sales in the US. Mexico being a significant exporter of automobiles to the US and in general on manufacturing. Having a weak peso, having low electricity prices in Mexico. I think all of that actually makes for a relatively strong constellation of external factors pushing the Mexican economy to have a strong 2015 and 2016. I also think that, I mean, all of the uncertainty associated with the structural reforms, the fiscal reforms, etc., is way past the Mexican economy. So I think we minimize the effects of the uncertainty generated by these deep structural reforms on growth and on the economy. I mean, we saw it both in Chile and in Mexico. I mean, regardless of what we think of these reforms, and I think they were good, but I mean, having 2 years or 18 months of discussions of fiscal reforms, of regulatory reforms, etc., I mean, actually affects investment. I mean, you do a reform in Mexico, you do an antitrust reform in Mexico, and I think that's pretty good. That's extremely good for investment in the long term, for employment, for income distribution, etc. But I mean, today, I mean, a significant part of investment is being done by these firms. Mm-hmm. So these firms will sit back and wait and see. So the effects of these discussions, I think, had an important effect on investment. The same thing might be true in Chile with the fiscal reform. And now these discussions are over. So I do think that everything is set for the Mexican economy to start to recover at a faster pace and with a financial system that has capital to lend, etc. On the main reform, that is the energy reform. I think that, I mean, obviously, if you look at the portfolio of projects that will make the brunt of the additional investment on the energy sector, obviously some of them will see their profitability significantly affected by a price of oil that is half of what it was 6 months ago. Obviously, this portfolio might be affected in an environment in which major energy firms are thinking of cutting back and not of expanding. And also in an environment in which maybe there will be a lot of cheap buys out there that will be competing with the projects in Mexico, in Vaca Muerta, in Argentina, or in the pre-salt. I mean, you might have, I mean, nice opportunities in Texas that maybe have lower uncertainty, etc. So expected profitability by the firms going into Mexico will be much higher, and that will depress the amount of money that they will willing to bid for the Mexican projects. But having said that, I mean, after 50 years of a closed energy sector, I mean, the amount of potential projects that are available in Mexico, both in, I mean, transportation, petrochemicals, secondary recovery, shallow waters, I mean, it's so huge that I think with intelligent reprofiling of things, postponing some of the most complex projects a couple of years and bringing forward some of the less complex projects, I think still the effects of the energy reform should be felt. There might be delay, the intensity might be not as high as we thought some months ago, but still I think there's a lot to work with, and there's a lot that might not be that affected by the price of oil. So, and I think that that is true also for, I mean, for Argentina with Vaca Muerta, and in a sense, there were very important developments in the energy spectrum in Latin America that obviously will go through some reprofiling, redesign, etc., under the new scenario of oil prices now.
And Brazil, I mean, you alluded to, I think we're finally seeing kind of a real correction in policy signaling coming from the new economic team, and I think but the growth outlook remains really challenged this year. Question mark for next. You've got, you know, the combination of a stronger fiscal adjustment, monetary policy tightening, but then kind of the risks, the Petrobras scandal weighing on investment by itself potentially, and the construction sector, the energy rationing question. So the fund is at low growth, and many people think you can have negative growth this year. In terms of a rebound, kind of how quickly do you think Brazil can come out of kind of where the poor growth outlook this year, kind of, you know, and what are the key, you know, from the fund's perspective, the key policy initiatives that need to kind of be put in place to kind of strengthen? I mean,
I think there are two, I mean, as I said before, it's hard to come up with very high numbers of potential growth for Brazil. But weighing on the difference between low growth and no growth, that is what we're having today, is very high. So we think that, all the correction on the macroeconomic framework and some of the main micro policies that were used with macro objectives in the past. Trying to contain inflation by containing energy prices or by lowering taxes. The correction of all that policy package that was put in place in the last 3 years, together with a fiscal consolidation path, a strong reaction by the central bank to contain inflation and to anchor inflation expectations, and the announcement to let the exchange rate do its work in terms of realigning a major relative price, I think goes a long way in terms of generating this rebalancing towards investment, towards exports, and reducing the importance of consumption in the growth process, together with the reduction in policy lending by development banks. So I think that block of policies implemented correctly throughout 2015 will start generating, I think, credibility and business confidence, etc. And I think there's a lot of postponed investment in Brazil from the last 3 years, under the uncertainty on whether the previous macro framework was going to be intensified going forward. So I think to the extent that the current policies will earn credibility and will be sustained, I think it's feasible to expect that a lot of that pipeline will start coming in train, and we'll start seeing that in the future. And that's why, we are expecting, some recovery in 2016. And I think there can be some upward biases into that, in this credibility effect. You look at Brazil CDSs that were, trading inside of Mexico, they have widened significantly. So there's a lot of scope for this macro framework adjustment to actually generate some expansionary effects in a period of 2 years. I think that's going from that to high growth, I think also requires significant structural policy changes. They're doing some by correcting these macro things that were done in the past, like electricity prices, gasoline prices, etc. But when you go to, when you go to the fundamentals of growth and investment in the Brazilian economy, the ease of doing business, the tax system, their trade, being one of the closest economies in the world, etc., there's still a big job to be done in that front to actually think that we will be seeing investment rates in Brazil at around 22, 23%, that will give you much higher growth. So I think there's those two blocks. The new government has been in place for less than 4 weeks, and I think we have seen significant announcements on the fiscal side, on the macro side, on the energy side. So I think we have heard very positive noises. If they accomplish this, then I think the big question mark will be, well, on the structural side, how aggressive can they be? But I think so far it has been extremely positive. No.
Let's open it up for questions. So I don't know if there's someone around with a mic there.
There should be somebody around the mic. There's somebody in here.
Perfect. And can you identify yourself when you ask your question, please? Thanks.
Sure. Thank you, Jorge Campos from Bank of Tokyo. Thank you very much, Alejandro, for that discussion. Clearly, the growth model for Latin America is exhausted of cheap capital and, a very eager Chinese market to consume the exports. A question also on the governance that you're seeing in Latin America and the impact that has on growth prospects. Clearly Petrobras is a big issue in terms of the construction and infrastructure that you would expect to see. In Mexico, you've had similar allegations around, I don't know if it has a name to it, but maybe house state at this point. In Argentina, the uncertainty that surrounds it. So is governance an issue that's also constraining growth? Do you see that growth for the next 12 months hindered? And is that something that the fund incorporates in its growth outlook for this year?
I mean, I think, it's obviously a very important issue. I mean, if you look at a lot of the literature on growth and you look at the institutional determinants of growth, I think, the strength of institutions is very important. Acemoglu made a name for himself actually doing a lot of research on this issue, and I think it's very important. And the weakness of institutions in Latin America is a factor. Obviously, conflict of interest, issues of corruption, etc., are things that show up also in this literature as hindering sustainable growth in the world. The strength and the efficiency of the judicial system, it's an important determinant of growth as well. A lot of these things are correlated and endogenous, and it's hard to pinpoint their effect. But I totally coincide with you that that's a medium-term issue for Latin America that ends up affecting investment, affecting total factor productivity growth, affecting long-term projects in the region, etc. I wouldn't say that that's an issue affecting our short-term projections of growth, because this is a structural issue that needs to be worked on, and it was there last year, it was there 5 years ago, it was there 10 years ago, but it's certainly an issue that these economies have to work on. Strengthening institutions, strengthening the rule of law, and strengthening governance, as you said. And going back to your question, Lisa, before, obviously the issues in Petrobras, the conflict of interest issue, that are being handled by the Brazilian judicial system appropriately, but are affecting the capacity of the firm to fund itself and to implement their CapEx program. Secondly, this is feeding through in the same manner towards major construction firms in Brazil, and therefore affecting the infrastructure program. So actually, in our forecast, part of the reduction on growth has to do with this. And I think if you look at total investment in Brazil, in Mexico, a significant part of total investment in these economies is being done by the energy sector. No? So it is macro relevant for Brazil and for Mexico and for these countries.
Other questions?
Thank you, Alex and Lisa, for that excellent discussion. Alex, you expressed a lot of, I'm Nader Nazmi from BNP Paribas. You expressed a lot of optimism, seems to me, about growth prospects for Mexico in 2016. Let me ask a couple of questions on that. One is that, so construction sector is recovering, a nice U-shaped recovery, but seems like the mining sector is becoming the drag on growth. And given Pemex's problem this year and next, it's going to be with us for a while before foreign participation in the sector. So the mining sector will be a problem next year in 2016. And then if oil prices remain where they are, and the government can't spend next year, this year they're okay, they're hedged, but next year they will have to substantially reduce their spending if they want to keep that 3% fiscal target. So 2016, is it really that positive for Mexico's growth, you think?
Okay, let me just adjust what I said so people don't say that I have a conflict of interest, not in Mexico. But what I was saying is starting from a low base, to the extent that we were expecting much higher growth in Mexico in 2014, and that did not materialize. We think that the recovery in the US took a little bit longer to gain traction, given the bad first quarter associated to winter, and maybe the correction of the issues in the construction sector took longer than what we expected. And as I said before, I mean, we might have minimized the negative effects of uncertainty on investment. We think all of that is behind us. Now the US is doing better, the exchange rate is weak, and electricity prices are low. There has been a lot of investment in the auto sector in Mexico that should come into production and help the Mexican economy. So I do think that from a cyclical perspective, our projection of 3.3% growth, that is not marvelous after growing 1 and growing 2 on the previous year, and our expectation that growth in 2016 is going to be 3.5. It's not, so we actually have been pretty cautious, even before the drop in the price of oil, in assessing the impact of the structural reforms on the medium-term prospects of the Mexican economy. I do think that from a medium-term perspective, I mean, in 20 years we will be sitting here talking about the energy sector in Mexico, and it will be something, I mean, what happened last year would be the cause of a significant change in the sector. However, in the horizon in which we do projections, we thought even before that the effect was going to be gradual, and it's going to be, let's say, on the lower end of the range of what analysts were saying. I think another important thing for Mexico that is a little bit embedded in these projections is that we have, I mean, minimize the negative effect that China had on Mexico's growth between 2001 and 2008 or 9. So the 2% growth on average that Mexico has had in the last 12 years, I think is also explained to some extent, I mean, not by the adjustment that the Mexican economy had to do to accommodate to the competition from China, and that's already a little bit behind. But basically our medium-term scenario for Mexico, it's a growth rate that went from 3.3 to 3.5 and gradually maybe towards 4 as the effects of the structural reforms feed through the economy. That was our view of Mexico. Regarding oil, I do differ a bit from what you're saying. I think 2015, with the hedge, they don't have a fiscal problem. But even for 2016, the exposure of the Mexican fiscal accounts to oil is much lower than what it used to be. Especially, given the decline in production and given the increase in imports of gasoline, when you look at the sensitivity that the Ministry of Finance publishes of the fiscal accounts to a decline of $10 of the price of oil, might be somewhere around 0.2, 0.23% of a percentage point of GDP. So you will say, okay, this shock, if the price remains here, it's 1 percentage point. But that's completely manageable from a medium-term perspective, given the strength of the balance sheet of the government. They had to handle it, but I think they had the instruments to handle it, given that their exposure to oil has declined significantly in the last few years. It won't be easy. While I was in government, I tried to do many fiscal reforms, and we were not that successful. But it's not unfeasible, and I think it is an adjustment that they can do. And in an environment in which the U.S. economy continues to grow up above 3%, that might take off some basis points from growth. But if the Mexican economy recovers, they will be able to sustain those higher rates of growth going into 2016 or 17.
Other questions back there?
Melko Ebers, CEO of New York Business Consultants. I'd like to really appreciate that you share your profound views on the region, and I have two questions. One is, given the high rates of inflation in the region and the kind of coexistence of the Mercosur bloc, the expansion of NAFTA, do you see some trends for more economic political integration, the way we've seen it with ASEAN, the European Union? Will there be a Latin American central bank maybe at some point? Are there some discussions going on? And the second question is, when I thought of the remark of the guest from the Bank of Japan, one of the most equal countries when it comes to income distribution in the world, has its own set of problems and reforms. And Brazil, given one of the most unequal when it comes to income distribution, has growth become more inclusive? Do you see some trends that while the commodity and mining sector have their problems, that growth actually might change and become more inclusive? Maybe through support of entrepreneurship and innovation. Like, can there be other sources of growth that you see kind of blossoming slowly that make growth in South America more inclusive? Thank you.
I mean, the answer to the first question is no. I mean, in a sense, given the difficulty that has been present in the last decades to actually achieve more economic integration, I mean, trade integration, etc., in Latin America, I mean, thinking about monetary union, etc., it might not even be wise to do it. But, I mean, given what we have seen, all the preconditions that you actually need to have a working monetary union. So, I mean, Latin America doesn't seem to be a natural economic region where you actually would want to have a monetary union, but then politically and diplomatically, etc., we are way off. And I think what would be more important now and more realistic is to think on the possibility of having more trade integration. I think, I mean, there's a movement on these Pacific Alliance countries of strengthening economic integration. There's also obviously the Mercosur countries having formed a customs union, etc. But I think the aim should be, with a medium-term perspective, to have a much more integration between all the countries in Latin America, and to actually significantly reduce the transaction cost of doing business in all of Latin America. And there we have seen business moving significantly ahead of the public sector. I mean, you see these big Latin American corporates doing business everywhere, and I think the job of policymakers should be actually to make the job of the private sector much easier in their cross-country business. The second question was on inclusiveness. I think there has been, I mean, a significantly push for more inclusive growth. I think if you look at how income inequality has improved in Latin America and poverty has been reduced, and Brazil, I think it's a great example of that, both through growth, through increasing wages, and through increasing social programs that are much more progressive than the traditional real spend through the budget. Obviously, there has been very important improvements. I think the interesting question now is how Latin America can sustain this inclusive growth model in an environment in which Latin America grows by significantly less. The government balance sheet is, or the government budget constraint is much tighter. And in that sense, I think focusing on the efficiency of public expenditures will be very important. I think an issue that in Latin America is still not as high as other regions in the world, but it's still prevalent in many countries in Latin America, are energy subsidies that are extremely regressive and could be a source of income to actually generate more progressive policies. And I think with a medium-term perspective, and touching upon your last point, is education. I think Latin America, in some countries, they spend a significant amount of resources in education, but they're not getting the results in terms of quality. I think there was a big push in terms of coverage, but in terms of the quality of the education, when you look at all these PISA scores, etc., Latin America scores extremely poorly, and I think that's a very important issue. And when you talk about inclusive growth and business opportunities and R&D, and I mean, there are tons of business opportunities actually being developed in Latin America that are actually addressing these new middle classes, these segments of the population, etc. And I think there should be a lot of innovations coming from the region addressing problems that are more acute in the region than in other places, and that eventually we will be seeing more and more. I think there's also an important issue of linking much more our educational systems to the corporate world. When you compare the educational systems in Latin America with those in the Anglo-Saxon world, I think the distance between what we do in universities and what we do in our jobs is much wider, and therefore maybe we're spending too much in basic sciences and not enough in applied sciences, etc. But I think a significant rethink also of our educational system, both in terms of achieving higher quality of education overall, but also linking it more with the economy, with the corporate world, etc., with the generation of new business, new ideas, etc., should be very important for what you were saying in terms of a new growth model going into the next decade.
I think there were another question back there, and there was someone over here too.
Hi, hello.
Right here.
Oh, here, yeah. Hi, Armando Rosselli from MSIM. Thank you for this presentation. I just wanted to ask you, where do you see 5 years from now foreign ownership of domestic bonds, considering that all the tailwinds, the secular tailwinds, are kind of reversing now?
But I mean, if I knew that, I would be trading bonds. And I mean, no. I mean, yeah, it is like like the question, where do you see the exchange rate, etc. I mean, I think everything that we have seen points towards. I mean, obviously, many factors affecting the trend towards the holding of institutional investors of emerging market debt and emerging markets local debt, and I think I haven't seen a lot of research really studying how important are each of these factors, and in a sense there's a lot of research focusing on the effect of international liquidity conditions in capital flows, but I think also we have gone through the shifts and shocks, like Martin Wolf calls them in the world economy since 2008, that I think it's a fundamental shock. I mean, if you really think of how the composition of an international portfolio should look in 2005 and should look in 2015, when debt in advanced economies has significantly increased, in terms of managing that credit risk, you would like to have much more emerging market risk than advanced economies risk than what you had in 2005. So I think there is a paradigm shift, a structural shift towards a much larger presence of foreign investors in our local markets, etc. But there's also a significant shift that was basically triggered by international liquidity conditions that is going to reverse. And I haven't seen anything that actually tries to study what are the effects of these, let's say, two important determinants of foreign ownership in, let's say, in local markets. So it will be very hard to quantify an answer to that.
Over here.
Yes, hello. Parker Lee from Baker Hostetler. With respect to U.S. economic foreign policy, have you and your colleagues been surprised at the engagement or lack thereof between the U.S. and Latin America, and going in, let's say, the past 5 years? And going forward, do you expect that to increase, or do you expect to see more interaction between Latin America and some of the larger Asian economies?
I mean, what I've seen since I've been at the IMF and what I saw when I was in the Mexican government, I mean, it's a very heavy engagement of the US government with Mexico, and since I've been at the fund, with Latin America. It's also true that, I mean, the political and economic frameworks that were adopted in Latin America in the last 10 years, and the commodity boom generated first the possibility from some governments basically to isolate themselves from a regional dialogue. I mean, obviously the US had other issues to deal with, such as its local financial crisis, and from a diplomacy point of view, I mean, other regions of the world that were much more problematic. So, I mean, I would say that to some extent, I mean, what you're referring to is just a reflection of circumstances that needed less engagement from both sides, and that less engagement can be interpreted as a lack of interest on one of each of the sides, and also a polarization of views in Latin America that might have made it more different or more difficult to the US to engage with the region. And then on the, let's call it the supply side, also the US being heavily involved in other issues. I mean, I think a lot of those things are kind of diminishing. I mean, the US economy is doing much better, and from a financial point of view, the US can re-engage with the rest of the world in a much more intensive way in non-crisis related issues, no? So in a much more positive engagement vis-a-vis the region. I think also the end of the commodity boom is making this extreme polarization of the region something that maybe will disappear in a 5-year horizon. No? I think that we will see some convergence in economic models in the region, and that will also bode well for a larger integration among the region and with the US. And finally, I would say that I mean, whatever the US is doing with China shows that, I mean, there's with China, whatever the US is negotiating now with Cuba, etc., has, I think, also the potential to generate a very different dynamics in terms of how the US engaged with all of Latin America. So I think things look better for the engagement of the region and the US, and for the engagement between the countries of Latin America. So that would be my answer to that.
We have to close it here, but thanks so much for joining us. Randy, I don't know if you want to make any other final comments. Thanks, Alex. I think it was a great discussion.
Thanks. Thank you, Lisa.